China has just hit U.S. exports with a staggering 125% tariff. But that's not even the real story. The real story is what happened next. What they did after slamming the tariff into place, quietly and decisively reconfiguring the flow of global trade. Behind the closed doors of Beijing, moves were made so carefully calculated that by the time Washington reacts, it could already be too late. This isn't mere retaliation. It's decoupling, a process unfolding at a pace that few in the West are prepared to face, and it's happening right now. On April 10, 2025, China imposed crushing tariffs on key American sectors: automobiles, tech, machinery, semiconductor parts, all of which pumped over $36.4 billion into U.S. exports just last year. And this wasn't just a random economic pushback. No. This came just 72 hours after President Trump authorized $88 billion in new tariffs on Chinese electric vehicles and rare earth minerals. The timing wasn't coincidental. Bloomberg analysts called it a precision strike, but it was much more than that. It was a calculated move, both economic and strategic, meant to send a message. Wang Yong, senior advisor at Ping University, made it clear. Beijing is targeting high-leverage industries tied to electoral politics. This is no longer defensive, it's surgical, and the market felt it immediately. Tesla halted shipments to China. Deere Co lost $2.1 billion in market value within 2 days. U.S. soy futures slipped 4.3%, as speculation swirled about the possibility of even broader retaliation. But beneath the chaos of tariffs and market dips, something much deeper is happening. China didn't just respond to the tariffs, they repositioned. This wasn't a countermeasure, it was an exit strategy. While headlines fixated on the immediate shock of tariffs, the real shift was happening under the surface. The structural changes were already underway. By the end of the first quarter of 2025, according to China's State Administration of Foreign Exchange, Beijing had slashed its U.S. Treasury holdings to a 15-year low of just $668.6 billion. And that's just the beginning. Major Chinese banks like the China Construction Bank and ICBC quietly halted all new dollar-dominated loans for state-backed projects. Instead, they pivoted toward financing in RMB or euros. Reuters confirmed this shift as part of a broader strategy to insulate China's economy from the West, an intentional decoupling meticulously executed. Goldman Sachs economist Maggie Wei issued a stark warning. China is engineering a soft retreat from dollar liabilities to preemptively guard against future sanctions. If China's not waiting for the next round of tariffs, then what are they preparing for? The language coming out of Beijing gave us a hint. On April 11, China's Ministry of Commerce declared certain U.S. imports to be no longer commercially viable. It might sound like bureaucratic jargon, but it's anything but. By framing American goods as economically inefficient, China has shielded itself from possible WTO retaliation while signaling to its domestic companies to abandon U.S. suppliers. This isn't just a trade strategy, it's an engineered retreat. Within days, BYD, one of China's top electric vehicle manufacturers, dropped a $500 million sensor supply deal with a U.S. firm. Analysts like Henry Gao, a trade law expert at Singapore Management University, called this phraseology a regulatory green light for companies to sever ties with American suppliers disguised as market logic. But the real question is what happens when market-driven decoupling becomes the norm. Behind the scenes, even some U.S. allies are quietly hedging their bets. In March 2025, Germany's BASF signed a massive $7.2 billion expansion deal in China's Guangdong province, its largest outside Europe, despite U.S. pressure to reduce dependence on China. In Saudi Arabia, a landmark crude oil deal was struck with China's COPEC, bypassing dollar invoicing entirely and using digital Yuan for the first time. France is lobbying for a BRICS EU forum, while Brazil pushes for Latin American payment systems to be interoperable with China's. These aren't isolated actions. They're part of a slow but steady pivot. A new world order is emerging, one where Washington no longer calls the shots. Krupp strategist David Lubin warned, a multipolar trading order is emerging, and Washington is no longer the default center. If America's allies start to abandon U.S. trade policy, how long before China isn't the one on the outside looking in? The truth is, America's sanctions toolkit is finite, and Beijing knows it. As of April 2025, the U.S. had sanctioned over 640 Chinese entities, yet trade volumes remain resilient. China's exports to ASEAN nations rose 7.4% year-over-year in Q1, offsetting losses from the U.S. Meanwhile, dollar weaponization is beginning to lose its bite. The yuan's share of global cross-border payments via SWIFT has jumped from just 2.2% in 2020 to 6.3% now. Even the semiconductor chokehold on China is showing cracks, with Huawei's new 7-nanometer chip, made with a mix of Chinese tools and stockpiled Dutch equipment, a clear sign that sanctions have accelerated local innovation, not stifled it. Former U.S. Trade Representative Robert Lighthizer admitted, "We underestimated their capacity to work around us, and if sanctions are backfiring, what's left in Washington's arsenal?" Wall Street isn't waiting for an answer. The market is already bracing for the inevitable. On April 10th, the Dow plunged 1,000 points, wiping out $520 billion in market value, as China's tariff hikes hammered key sectors like U.S. agriculture, industrial machinery, and EV components. The winds of change were blowing. The U.S. may find itself caught in a storm of its own making. Time is running out for Washington to act. Archer Daniels Midland, a cornerstone of global agriculture, crumbled by 11% in just 2 days. The market recoiled as Deere Co sounded the alarm, revealing that over $3.2 billion in inventory bound for China was on the precipice of disruption. At the same time, Goldman Sachs made a sharp and ominous move, slashing its Q2 U.S. GDP forecast from 2.3% to a meager 1.5%. The firm pointed to the direct hit from retaliatory tariffs and the slower, more insidious drag from the curtailment of exports. The signs were unmistakable. America's economic engine was showing early signs of a breakdown. Former Treasury Secretary Larry Summers went on Bloomberg surveillance, expressing what many feared but few had the courage to say. The markets, he warned, were sending signals that the administration hadn't yet fully processed. This wasn't just a trade dispute, this was an economic firebreak, a cascade of consequences that threatened to ignite and spread through the core of the global system. And then came the key question. What happens when corporate America, already feeling the heat, demands a truce while Trump's base, fired up and unwavering, continues to call for an escalation? The battle was no longer one of tactical victories. It was a war of wills. One that would decide whether the global economic system as we know it could even survive. But while the U.S. was embroiled in its internal contradictions, China had already made its next move. Xi Jinping, ever the strategist, wasn't looking for a quick decisive victory. His game wasn't about speed, it was about endurance. Since 2021, China had quietly but forcefully increased domestic chip production by 34% annually, according to the China Semiconductor Industry Association. At the same time, China had slashed U.S. soybean imports from a towering 32 million metric tons in 2018 to a projected 9.4 million in 2024. It wasn't just a shift in imports, it was a recalibration of China's supply chains, a reordering of its agricultural reliance. The move wasn't an accident, it was a deliberate reshaping of China's economic structure. China had already signed multi-year grain deals with Argentina and Kazakhstan to buffer against future shocks, and Beijing ramped up its sovereign food reserves by 18% year over year. This wasn't just preparation, it was a quiet fortification against whatever would come next. But perhaps most chilling was the confirmation from China's central bank. In April, People's Bank of China Governor Pang Gong announced that China's foreign reserve portfolio was actively shifting away from dollar-heavy holdings. This was no mere financial maneuver, it was a deliberate effort to insulate China from U.S. financial leverage, to create a buffer against the global influence of the dollar. Meanwhile, back in the United States, Trump faced the growing storm of his own making. Inflation expectations ticked up to 3.1% in April, according to the University of Michigan's Consumer Sentiment Survey, signaling a deepening strain on American households. The economic ripple effects were undeniable. As strategist Kevin Rudd pointed out in Foreign Affairs, the timeline for China wasn't 2025, it was 2050. This wasn't a sprint, it was a marathon. The real contest, it seemed, wasn't about who could strike the hardest. It was about who could survive the longest, who could outlast the other in this relentless economic war. American farmers, the backbone of the U.S. agricultural economy, were already absorbing the full weight of this policy without the relief that many had hoped for. According to the American Farm Bureau, over $8.6 billion in agricultural exports to China were at risk by 2025, primarily soybeans, corn, and dairy products. But the numbers didn't tell the full story. Landis, an Iowa-based cooperative, reported a 37% drop in forward contracts with Chinese buyers this spring. The cost of these tariffs, and the uncertainty surrounding them, was bleeding farmers dry. It wasn't just the agriculture sector feeling the squeeze. Walmart's CFO, John David Rainey, warned during the company's April earnings call that the tariffs were already driving up input costs, which were in turn pushing up prices on core essentials across the store. The Bureau of Labor Statistics confirmed a 0.6% increase in food prices in March alone, a figure that, in the broader context, showed just how far-reaching and disruptive these policy changes were. This wasn't just an abstract economic debate anymore. This was tangible. It wasn't just a rift. It was a total redesign of the global economic system. According to the IMF's April 2025 Global Economic Outlook, global trade was fracturing into regional spheres of trust. China, the rising economic superpower, now led a bloc that represented 33.6% of global GDP by purchasing power parity, surpassing the G7's 29.9%. And the US, despite its vast economic might, was being increasingly sidelined in this new order. The numbers didn't lie. Cross-border investment flows between the US and China had plunged by 58% year over year, according to the Rhodium Group. Chinese tech giants like Xiaomi and Huawei, once part of the vast global supply chain connected to the US, were redirecting their manufacturing expansions to places like Indonesia, Egypt, and Mexico, further distancing themselves from the American economic orbit. Even in Washington, a new cold wind was blowing. The U.S. Congress was considering legislation that would prohibit federal pension funds from investing in Chinese equities. This wasn't just a sign of political tension, it was a signal of the broader process of financial decoupling, a gradual separation that few fully understood but many were already preparing for. And yet, despite all this, there was no coordinated effort to reverse course. As Morgan Stanley's chief global economist Seth Carpenter astutely observed, we may be past the point where the two economies can fully reintegrate. We're not watching decoupling, we're watching divergence. If the old global economic system, one rooted in the intertwined fates of the United States and China, was truly unraveling, the question became, what would replace it? This was no longer simply a trade war, it was a strategic unraveling, a slow and deliberate tearing apart of an old order, one thread at a time. China was slamming the brakes on its reliance on the US dollar. US firms were being systematically carved out of supply chains. Wall Street, sensing the shift, was adjusting in real time because, in an environment where the old rules no longer applied, the markets had to adapt quickly or risk being left behind. But the real warning shot, one that seemed almost innocuous at first, came on April 5th when China's central bank confirmed it had completed its first cross-border energy transaction using the digital yuan. The deal, worth a staggering $2.9 billion, involved state-owned pro-China companies and an unnamed supplier in the Middle East. The most shocking detail, not a single US dollar had been used in the transaction. This wasn't just an experiment, it was a fully realized execution of China's broader financial strategy, and it was moving fast. The implications were staggering. If China scaled this model, linking it to the global financial infrastructure through platforms like SIPs, BRICS Pay, or even oil trading platforms in Africa and Latin America, it wouldn't just bypass the dollar, it would redefine the very currency of global trade, shifting power in ways that the United States could no longer ignore. The real question then isn't just whether Washington will get a seat at the table, it's whether the table will even exist in the same form in the near future. If Beijing forces the next generation of trade to clear in yuan, will Washington even have a place in this new global order? This is not a theoretical discussion, it's happening now. The old world is dying and something new, something that will reshape the global economic landscape is already being born. Drop your thoughts in the comments. We're glad you're following this unfolding story. Don't forget to like and subscribe.